Hello, everyone, and welcome to the March ACEC RT Financial Wellness webinar, where we'll be discussing market volatility. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And third, this webinar is set up to be interactive through the use of polling questions throughout the presentation. We encourage you to participate as the questions arise. At the end, we will take some time to go through the questions you've submitted through today's webinar. And now I'd like to introduce our guest speaker of Invesco, Tracy Fielder. Tracy is a senior strategist of the Rethinking Risk Thought Leadership Program. He heads a team which develops the themes, researches the data, and presents the concepts concerning risk and volatility in the market and how it can affect a client's portfolio. The Rethinking Risk program is Invesco's approach to looking at risk holistically by considering market history, investor psychology, behavior, and asset allocation theory application. This program and philosophy also looks at portfolio construction by diversifying across sources of risk in relation to various market and economic environments. Thank you so much for joining us today, Tracy, and now I'll turn it over to you.
Well, thank you, Tori, and thank you all for spending your time today with me. I know your time is valuable, so I want to hopefully this will provide you some education in looking at how we can benefit from diversification in retirement savings. You know, we're going to talk a little bit about volatility. In fact, that's going to be the main theme. Not a little bit, a lot about volatility. And I think it's important because I think given with all that's going on in the market, whether you're reading CNN or you're reading Wall Street Journal headlines or Barron's or just your local news, you can certainly see issues going on with the stock market. And some days it's up 300 points, some days it's down 300 points. Some days there's good economic data comes out about the U.S. economy or the global economy, and some days it's bad. And you see different asset classes, bonds responding, stocks responding, oil and other commodities responding to different cues that we receive regarding economic data and growth data, supply and demand. And so we're going to talk a little bit about that, but I wanted to set up kind of what we mean by diversification. And some of you folks may know this really well, and I'm going to keep it on a base level because I think this is a good example. If you look at one of the most defining ways to look at the United States government, what defines the United States, it's the separation of powers. And so if you have the legislative branch, the executive branch, the judicial branch, and look at how they were intentionally designed by the founding fathers, they were to provide us with a system of checks and balances. And so the idea is to not have a single branch that holds a disproportionate or an overbearing influence on the future of the country at any point in time. And so that same concept really holds true for portfolio construction and diversification. And so what we're going to talk about today is to have a true system of checks and balances in your portfolio. Investors really should look at a variety of different asset classes, really so that volatility in a single asset class, like stocks, which we'll talk about today, doesn't dominate the outcome of your portfolio and affect your future, especially in terms of retirement planning. And you know, we're all prone to this. Investors, many times, and it's been proven through data, do the wrong thing at the wrong time. The old adage of buying low and selling high is easy to understand. I think anybody understands that. You buy a stock at 10 and sell it at 20, you've made money, right? You doubled your price. But I think what happens is many investors have a tendency to avoid whatever is not doing well at the time, whatever asset class is not doing well at the time. And we see this, we saw this after the 08 and 09 financial crisis. You look at asset flows, we didn't see positive flows into the equities or the stock market until 2013, and that's after the market's already done well for 4 years. So a lot of times your investors are late to the party when it comes to following asset class performance. And I think our challenge isn't to try to predict what's going to happen with the markets, because none of us can do that. But really what we're trying to do is understand the volatility's impact on our markets and over the past history going back 100 years. And so we're going to look a little bit about that today. So we're going to look at 3 areas of volatility today. And first, what we're going to do is look at the past. And we're going to examine the historical volatility of stocks, bonds, and commodities. Next, we're going to discuss ways in which we can focus on what we can control in terms of retirement savings. And finally, let's talk about how we can be prepared for our future financial goals, and mainly through retirement savings, but there's other financial goals, children's education, etc. So let's start with understanding the historical volatility of stocks, bonds, and commodities on the next slide. We'll start off with stocks. And so, I'm sorry, this is the first polling question here. So this is an interesting way this isn't a test, so it's not really a right or wrong answer, but we're interested in seeing what you think of some of these ways to answer this question. What's the most important in terms of reaching your financial goals? A, outperforming the stock market, like in other words, the S&P 500. B, never losing money. C, being able to sleep at night. Or D, determining your required return and timeline to meet each financial goal, college education, retirement, second home, etc. And just to note, D is one option. It looks like there's a fourth option, but the each financial goal is just the second line of D. And so if you wouldn't mind answering the poll, we'll see what each of the respondents are and go through that. Okay, so we have our poll numbers back. It looks like 25% of participants said outperforming the stock market is the most important financial goal, or terms in reaching your financial goal. 25% said never losing money, so it's kind of a bipolar way to look at it, or dichotomy. And then nobody answered 0% being able to sleep at night. And then D, determining your required return in time to meet each financial goal, college education, retirement, second home, etc. So about half of you answered that, and then the other were kind of on the two ends of the spectrum of outperforming the stock market or never losing money, which means actually taking zero risk. So let's walk a little bit through volatility and see if you would have answered these any differently by going to the next slide. And we're going to look at stock market volatility and the history of that. So, many investors' attitude about their investing is really based on their personal history, and it's usually based on the most recent personal history, whether that's good or bad. And so let's take a look at the Dow Jones Industrial Average over the high-flying time period. This is that many investors and some financial advisors kind of quote-unquote grew up in 1982 to 1999. And whether you grew up in it or may have read about it, you certainly knew about this bull market, or at least may have heard about it. So during these 18 years of this time period, the Dow Jones Industrial Average included only 2 down years, losing 4% in 1984 and 4% in 1990. We had 9 consecutive up years from 1991 to 1999, 9 years without a negative return, 13 years with returns of 12% or more, 10 years with returns of 20% or more, and 5 years with returns of 25% or more. That's incredible. Now, based on that experience, many investors really kind of believe that their biggest risk was missing out on the stock market returns. And so many investors that invested in that time period and have even heard about it kind of have this false sense of thinking that this environment represents quote unquote what's normal in the markets, and they're hoping one day it's going to come back. And in fact, some of those investors may be waiting for this type of environment to set up for return just in time for their retirement. But we know from studying market history that markets aren't always conducive to this type of environment and a stock-centric allocation, meaning mainly stocks are driving your performance. So let's take a deeper look at the years in which the Dow lost more than 10%, and we can see this at the bottom part of your screen here. At the graph, it says stocks have lost at least 10% 20 times in the past 114 years. So here we can see that losses of 20%, 30%, and 40% are probably not as rare as many people think. And the point is that these are not black swan or rare events. Now, does that mean investors should avoid stocks? Well, absolutely not. I would be remiss if I was to tell you that in a retirement plan seminar. In fact, investors really need stock exposure in their portfolios to act as your growth engine, right? And there's periods of time you certainly want to have exposure to stocks, and you should probably have exposure to a degree in most scenarios. However, really what this is to show you, just be aware the stock market, based on history, volatility should be accounted for in a financial plan, and you could experience a really rough ride in some cases. So we move on to the next slide. And we're going to look at the history of volatility in bonds. Now, bonds are the asset class that many investors really turn to escape volatility, and they use that as a flight to safety. And so you'll see that when the stock market sells off, like what happened in early January, stocks did really bad. In fact, we went into correction territory over negative 10% in the S&P 500 and the Dow by February the 11th, I believe, is what the market low was. And at that time, bonds were positive at the time. But while bonds may not be as volatile as stocks, they're more volatile than many people think. And so here we're going to illustrate just how often the bond markets really experiences significant price drops. And this is looking at daily bond prices since 1981. And so the bond market has experienced 4 drops of at least 15%, 13 drops of at least 10%, and 23 drops of at least 7%. Now, these drops may be surprising to investors, really who look at bonds as a non-volatile asset class. Now, does this mean you don't invest in bonds? Absolutely not. In fact, bonds, as I just mentioned, are used to quell stock market volatility, and much as what is built upon what we call modern portfolio theory, and is considered 2 of the most major asset classes between stocks and bonds. Let's move on to the next slide. Now, I don't think anybody would be surprised to learn that commodities have historically been volatile. This has really been evident more recently given the recent drop in oil prices over the past 18 months, starting in the 4th quarter of 2014 and actually went down into the 20s this past month in February. So very, very, very volatile times right now in oil. We're also going to look at gold. Many investors view gold as the ultimate safe haven asset class. And you've seen gold actually do well this year when the stock market did not. But if we take a closer look at commodity performance, we can learn some potentially useful things. So here we're going to compare the volatility of oil and gold to the volatility of stocks. And so if you look at the chart, you'll see the barrel of oil there, and it shows the drops of at least negative 10% or 274 times of the annualized return of positive 1.84% for oil over the 1983 time period to present. You see the stocks of drops in stocks, or the S&P 500 in other words, of negative 10% or more, but only 50 times during that same time period, with the annualized returns of average of 8.34%. We look at gold. Within gold, with a little gold bar there, we see drops of negative 10% of 113 times. We've seen that, with annualized returns of 4.77%. So gold fared better than oil, but the stocks during that same time period from 1975 until recently were only 62 drops of stocks between negative 10% or greater, with an annualized return of 8.88%. So what we've seen here, we typically learn in Investing 101, whether you learn that in school, college, or even in high school, or you read the Wall Street Journal or Barron's or various investor blogs or articles. Most of us have been taught to expect that the more risk equals more reward, right? And you can see from the return figures here that during that same time period, stocks, which experienced less downside volatility during this time, return more than both oil or gold. Now, see, one of the big mantras that we discuss in our Rethinking Risk program that Tori mentioned earlier on before we started this is that losses exponentially have a disproportionate impact to our returns versus gain. And if you understand that the old mathematical example of returns, if you lose 50% of something, it takes 100% return just to get back to even from where you started. So in other words, losses impact our average returns more than gains do. So why would investors consider investing in a volatile asset class? Well, it's because they're looking for diversification benefits through something we call low correlation. This simply means that low correlation means that commodities will act or return differently than traditional stocks and bonds. So we'll see this later in the presentation for times when commodities outperformed. So let's look at the next slide. And we see here that all commodities are not created equal. I don't want to spend a ton of time on this, but all I want to say is when you're investing in commodities, people use commodities as a very general term. We talked about 2 of the most popular, gold and oil, but we also have agriculture, which is representative of cotton, soybeans, etc. We have energy, which we already talked about, which is crude oil, diesel, gasoline, industrial metals, which would be your copper, aluminum, etc., and precious metals, which we also covered. But if you look across all of those, if you look at the left axis of the all commodities are not created equal graph, the bar chart, it says average correlation. The top says 1.00 and the bottom says 0.25. All this literally says is correlation is if something has a 1.0 correlation, that means it's a perfect correlation with each other. So if you have a stock A and a stock B have a 1.0 correlation between each other, when stock A goes up 10% between a certain time period, stock B will go up exactly 10% over that exact same time period. If you have a bond A and a bond B and they have a 0.2 correlation, that's a very low correlation, and that means that they're going to return differently over the same time periods, over different time periods. So for instance, a bond could return 5% with a 0.2 correlation to another bond that would return negative 1% because maybe it's a junk bond or a high yield bond. So the point of this is the lower the correlation, the more diversification benefits you'd have. And so that's really what we're looking for when investing in commodities. So some things to consider, what we've learned already. All asset classes have experienced volatility. That includes stocks, which we know, bonds, which are considered a safe haven asset class, and gold, which we just talked about, have experienced volatility, and commodities, which we're not surprised. Large losses are not uncommon, especially in the stock market, and investors must plan for them. And when you're meeting with your financial advisor, or if you do your own financial planning, you must account for those large losses. Higher volatility does not always equal higher returns if the higher volatility is downside risk, meaning you lose more or more times on the downside, you're going to experience, and that will hurt your returns. So let's move on to the next slide. Another polling question. This is question number 2. What is the biggest risk of investing for retirement? A, losing money during a market downturn. B, not outperforming the stock market. C, having to work longer than you originally wanted. Or D, not having enough money for everyday spending after contributions. And again, the D is only one choice. The after contributions in parentheses is not a choice. It's A through D. And I'll give you guys a few seconds to respond to that. Okay, so we have 50% of the respondents losing money during a market downturn is the biggest risk of investing for retirement. B was 0%, not outperforming the stock market. C, having to work longer than you originally wanted, 17%. And D, not having enough money for everyday spending is a third of the respondents responded to that. I can really sympathize with those who responded with A, losing money during a market downturn. None of us want to lose money during a market downturn. The reality of it is, if we're probably taking enough risk in retirement, depending on where you are, of course. If you're retiring next year, you probably don't want a whole lot of risk, but you probably want to have a little bit. But so you have to understand that a market downturn, you may have a negative return here and there. C, not having to work longer than you originally wanted. I could give my dad as an example. He took him another 5 years to work before he was able to retire from what he originally planned. And I read about a lot of in my studies, a lot of studies going on, and that's becoming a bigger problem nowadays from simply not saving enough. And we'll touch on that here in a moment. And then D, not having enough money for everyday spending. I think as we kind of talk about how you can save more and some of the things that you can consider, especially as you reach later on in your accumulation phase, as you save for retirement, we may be able to ramp up contributions because you'll have less expenses. So that being said, let's move on to the next part of the presentation. Okay, so that was the past, and so that was a quick study of that. And let's take a look where investors are in the present, and then what actions that we can take as a retirement investor within our power to deal with volatility. One of the mantras that the Rethinking Risk program is to focus on things that you can control. Can't control the markets, we can't control our returns necessarily, but let's look at a few things that we can. And so one of the first things that retirement savers can do is build realistic expectations for their portfolio. And so in this graph, we're going to look at a little bit what does that mean in reality versus of how we make a financial plan. So we take the returns of the S&P 500, which are the dark blue squiggly line from 1928 to 2014, actually to 2013, and that's a compounded average return of 5.62%. Okay, the light dotted line, that's a straight linear line, is actually a 5.62 linear growth over the same time period. That simply means that year over year, starting in 1928, you've averaged exactly 5.62% return. We know that that's not the way the stock market works. That's not the way any of our investments typically work unless you're invested in a CD or something along the lines of a fixed income account like that. But most investments you're going to invest in for retirement savings are going to have volatility. Well, here's the issue we have as investors. We all deal with this. When we're sitting down with our financial plan, we have to give us our fixed number, and we usually use this. Tori will talk about this in a little bit, but use financial calculators, retirement planning calculators that says, I want to retire at this age, or I want to retire with this amount of money, and with this amount of expected income, I need a required rate of return of X, 6%, 7%, 8%, depending on how much you're saving, and we'll talk a bit about that in a minute. But the point of that is whatever number you come up with based on your financial plan, whether you're doing it with an advisor or on your own, is a fixed number. It's going to be a linear rate of return. But the reality of that is not the case. As you can clearly see, most of the times the market's nowhere near where we expected it to be based on our financial plan on a linear assumption. So all we're trying to say with this is that we probably need to look at our financial plan, not on a daily basis. You'll drive yourself crazy doing that. But on a periodic basis, either with your advisor if you work with one, or on your own, and kind of see where you are with your plan, where you are now, where you plan to be in 5 years, 10 years, etc., and how far you are away from that, and you can make adjustments. Do you need more risk in your portfolio? Do you need less risk in your portfolio? That means, do you want to maybe add more allocation to stocks to up your risk, or more bonds to reduce risk, things like that? Or do we need to save more? We're getting closer to retirement. When we have a big gap from where we want to be, we maybe need to turn on the afterburner and save some more. So this is just a way to kind of keep on track and also set expectation to know that even though we need a 6%, 7%, 8%, 10% rate of return to meet our financial goal, it's not going to be that on a yearly basis, and so we just need to make sure where we are versus where we need to be. So let's look at the next slide. Okay, now this is an interesting one. I actually should call this how to get rich, and I think I have a lot more participants on this, but it's really the truth. In fact, most of the time I've been working in this industry for over 20 years, and I have friends that are in the industry, and they'll ask me, hey Tracy, what's the next best thing to invest in? Is it China? Is it oil? Because it's so cheap now. Is it gold? Back in the day, 4 or 5 years ago, when gold was going up to $1,900 an ounce. They're looking for, because media and you read books on how to get rich quick, and so you're looking for ways to make returns to get rich. But really, the reality of it, and we'll walk through this exercise, is when you look at retirement savings, the millionaire next door, so to speak, is typically the person that saves the most. Because what happens is your savings becomes your growth engine in your portfolio. Therefore, you can possibly take less risk. So let me walk you through this example to illustrate this for you. Scenario 1, we have a guy named Joe, and we'll just use him Joe, invest in 10% of his income of $100,000 over a 10-year time period. So that's $10,000 a year. And he builds this a fairly aggressive portfolio that earns 12%. And he averages 12% over 10 years. That's really good. This person is an excellent investor. This is a person bragging at the cocktail party. Okay? But even with doing 12% and taking basically a $100,000 investment, $10,000 a year over 10 years, they almost doubled their investment to almost $194,000. But look at the proportion of contributions versus market returns. The contributions are the light blue, 52%, so it's the majority versus market returns of 48%. So even making incredible average returns of 12%, which we haven't seen returns like that since the 90s during the tech and telecom bubble, you still the majority of your portfolio is based on contributions. So savings are important. Let's use scenario 2. Well, this person they want to invest, but they heard you could lose money in the stock market. They don't want to lose money in the stock market. They heard about 08 and 09. People lost 30, 40, 50% of their portfolios in retirement. Some of them haven't even been able to get back to even yet, or just now getting back to even after the market's recovered. So they don't want any part of it. So they put their money in a piggy bank, or the equivalent nowadays in their bank account. But they save 20%. Well, they save 20%, 0% return, but because they're saving 20% of $100,000 income times 10 years, do the math, 10,000 a year, or so 20,000 a year times 10 years is $200,000. So they beat the person that was an excellent investor that averaged 12% because they saved more. And so the lesson of this is not, and I repeat, capital N, capital O, capital T, not to put your money in a piggy bank, not to put your retirement savings even in a checking account, because making 0% return is not necessarily the way to go. You're not taking any risk, but you have no prospects for growth over that time period. But what this really illustrates is the more you save, as I mentioned earlier, the savings becomes your growth engine, right? And so you don't have to take on as much risk as somebody that doesn't save as much. So you can have a more moderate portfolio. So that's scenario 3. This person invests 20% of their income, $100,000, over a 10-year time period, but they build a moderate risk portfolio that earns 6%. And they have the best of the 3 scenarios, $274,000 in change. And during that time period, you can see here clearly, 73% of the portfolio is based on contributions, and only 27% of that's based on market returns. Again, they're focusing on things they control. They can control their savings to a degree, and when you control your savings, the more you save, you can control your risk in your portfolio by having less risk. So again, the whole idea with this is focus on things that you can control. So what have we looked at so far during this period? We want to be realistic about our volatility in our portfolio, and we're going to see portfolio volatility in the stock market. But understand it's not going to be the same year after year, even though we need a 7% return or 9% return. We're not going to experience it that way. So just be ready for that. 2, focus on putting away as much as you can. In other words, let your savings vehicle be the destiny. You control how much you're going to make, and then that way you can have a more conservative allocation and take on less risk because you're using as your savings vehicle or your contributions as your growth engine. Now let's take a look at the next slide. This is a tale of investors, and this is talking for you younger folks out there that are investing, and we're going to get to the people that have been investing for a while in retirement planning. But this is starting savings. These 2 investors are showing you the importance of starting savings early. So the first person, John, is the ideal investor. This person invests 10% a year from 1975 to 2014, and they invest in the S&P 500, and they end up with $7 million. Okay, that's because time was on their side. They invested for 40 years. Say he started at 25 years old, he retired at 65, $7 million portfolio. Of course, the market helped with that during the 90s and most past 6 or 7 years up until recently. Stock market's done really well, but all in all, they've done really well. Now, Emily started investing, and say she was 25 the same time John was, but she said, well, I don't have time to save right now. I'm buying a new house. I'm getting married. I'm paying off my student loans, whatever. I'll save later on. And she waits till 1985 to start saving versus 1975. She also invests 10% a year, but she has only 10 years less than what John invested, so only a 30-year savings. Her ending balance is $1.75 million, a $5.25 million gap based on that 10 years. Now, I will tell you right now, for full disclosure, that 10 years difference was during the 70s when John bought. 73 and 74 was a bear market, so John would have invested and started in the 75 when the stock market was very cheap. And then the 80s and 90s, when he started building money, he experienced that 18-year bull market that we talked about earlier on. But the bottom line is I can guarantee you through different examples, however many times you look at it, that time will be on your side. And so the earlier you can save, the better off you'll be. So let's look at the second part, and we'll look at a couple other scenarios here. And these are for folks on the next slide that have waited later on in retirement, and then we can see how we kind of get to where our savings goals need to be, kind of using 2 different paths. So William started saving over a 30-year time period, but for the first 10 years, he was a young guy, he saved 10% a year, but then he got promoted and started making more money. And for the next 20 years, after that first 10 years, he ramped up his savings to 20%, and he also added a 3% inflation adjustment per year. So that basically means every year he upped his contributions by 3% automatically, or he did it himself. Sometimes you can do that automatically in your retirement plan. And he ended up with $2.5 million portfolio, $2.52 million. Now Jane does what a lot of pre-retirees do. And I say pre-retirees are typically people that are about 10 years away from retirement, okay? And Jane waited, she saved 10% a year for 20 years and then got about 10 years away from retirement, and she looked at with her advisor, or she looked at on her own and figured out there was a big gap there. And so she dramatically increased her portfolio contribution to 50% of her income. And she ended up with a $2.5 million portfolio. Now, I know those of you saying, wow, 50% of my income, that's huge. I mentioned a book a while ago called The Millionaire Next Door. It's by Thomas Stanley. If you haven't read it, I would suggest maybe reading it. It's a great book. And what it's basically saying is that your average mom and pop, people that have a couple $1 million, $2, $3 million in retirement, your millionaire next door, was basically a super saver. They weren't a Warren Buffett at investing. They didn't pick, Reebok before it became expensive, or Nike shoes, or a certain video game, or Apple before it became, a multi-billion-dollar company. But they just saved and saved and saved and invested wisely and did it over the long term. And I think that's really the idea here. And they have to typically save between 35 to 60% of their disposable income. And so it can be done. And the reason is, especially if you're pre-retiree, if you're 10 years away from retirement, most likely if you're going to retire in your mid-60s, your house is probably paid for, or mostly. Your kids are probably out of college, or mostly out of college, and hopefully maybe it's paid for by then. But you have a lot of expenses that are probably paid for out of the way, or almost out of the way, and you can really focus on really hitting those last years and playing catch up if you need to. So let's move on to the next slide. This is a very important slide. We talked about setting expectations, and which is kind of path dependency. And path dependency basically means compounding of losses and gains. But compounding of losses and gains is really much more important in retirement years. This is going to talk about a retiree, somebody after they're retired, because they need portfolio income. They need to spin off income from their portfolio that they've accumulated over these years to fund living expenses. And so this example is going to illustrate that playing defense may be especially important early on in retirement. So here we are here with two different retirees as an example. We have $1 million stock portfolio in each example. They're making a $50,000 annual withdrawal, which is a 5% withdrawal of $1 million portfolio. They're invested in the stock market, the S&P 500. And they also adjust their withdrawals by 3% annually. Now, for this scenario, we have two return sequences, 1990 to 2010, which is the stock market annual returns of 1990 to 2010, is a blue line, retiree A, and the purple line is retiree B. And they receive a reverse returns, 2010 to 1990. Now, I will tell you that both of those series of returns, because of the same annual returns, even though they're in reverse order, they still equal the same average of 9.45%. Doesn't matter what order they're in, if they're going to average the same. But as we can see here as I walk you through this, when you receive those returns and how you receive that average return makes all the difference in the world when you're taking off money from a retirement portfolio. So let me walk you through this. Retiree A receives a return 1990 to 2010, the blue line. They have the benefit of the 90s bull market. They go all the way up to the 9th year. If you see on the top line years, all the way 9, 10. The 9th and 10th year, when it starts coming down, that's a tech and telecom bubble, 2000 to 2002. They received a pretty good drop right there, but they're still much higher than when they started at the $1 million. They had the recovery after the tech and telecom bubble up until the financial crisis, which happened in the 18th and 19th year, around 08 and 09. Lost again, but then they recovered back again, and they ended up with over $2.5 million in their portfolio. They're okay. They're the person that says, hey, I can weather the stock market. I've had some drops, I've had some losses, but I'm okay. And that's the kind of people you see a lot of times that have invested and have been invested and have weathered that storm. Let's take another look at the same person with $1 million portfolio going backwards in that same 9.45% average returns, but going backwards. So the purple line receives returns 2010 to 1990. So we go 2010, 2009, 2008. Boom, that's the financial crisis, 2009, 2008. That's why you get hit early on. Then we go back and further, and then we hit the tech and telecom bubble around year 10 again, 11 and 12. And at one point, you can see here that this original $1 million that they invested is down to $500,000. That's half of what they initially put in. That's the kind of investor that you see that got what happened in 08 and 09 that lost their money, and they got out of the stock market, and they were scared. They saw their money go down to nothing, and they saw it take a large loss, not down to nothing. But it was a bad time for them, and those are people that are still sitting on the sidelines, afraid to get it back in the market. So The point of this is to play defense early on in retirement. We know we need a moderate rate of return in retirement. We need to make something to beat inflation over time, but make sure that we're looking at those large losses and protecting from that by diversification early on. And so some things that we can consider. For retirees, it's more important to start strong than to finish strong. The point is we want to consider ways to potentially lessen the risk to have a significant loss early on in retirement to our original principal. And we can do that by balancing growth potential of stocks with other investments that have less or have offsetting features and return streams such as bonds or alternative investments. So that being said, let's look at our next slide. And this is our third and final polling question. What affects investor returns more? A, how many positive versus negative returns years you have. B, large losses. C, large gains. D, market timing, meaning buying at the lowest point in the market and selling at its highest. And again, the D is just one single thing, and selling at its highest is part of D. So I'll give you folks a few seconds to do that, and we'll count up the results. Okay, great. So 50% of respondents said how many positive versus negative return years you have. That's a good answer to that question, because that's kind of the example that we looked at with the more negative years and more downturns we saw of oil and gold versus stocks. So excellent. Large losses, we just talked about that. That certainly affects your returns because, again, that 50% return takes 100% return to get back to even. And then finally, D, I love this one because we did this earlier, and we received about the same. About a third of respondents said market timing, buying at the lowest point in the market and selling at its highest. There is nothing truer than that. The problem with that is doing it consistently. So if you can consistently buy at the lowest point in the market and sell at its highest, I'll invest my money with you because I've been doing this for 20-something years, and to get that right consistently has been a thorn in everybody's side that's tried it. But certainly there are things you look at with that. But this is great, guys, and so I appreciate you answering to this. And so let's get on to the last point here. And so we kind of talked about asset classes, diversification, volatility. You know, we're looking at our future here, right? We want to be prepared for what's to come. And so ultimately, we want to meet our financial goals. Most cases, especially you folks here on the phone, is going to be retirement, right? We want to reach retirement. And so we want to do that, but we want to be prepared for whatever market environment that may come between now and our retirement date, and then even after that. So we're going to look at 3 different market environments and to see why diversification is so important in these environments. Because kind of going back to the example with the government, investors think that they choose a wide variety of stocks. They think they're diversified. That means I own international stocks, I own small company stocks, I own growth stocks, and I own value stocks. And so they think it's diversified, but that's much like saying the Senate's diversified because all 50 states are represented. Well, you know, if you think about it, yeah, that's true, but only to a point. And as part of that legislative branch, the Senate plays that particular well-defined role in the overall system of our government, checks and balances, right? Just as stocks play a particular role in your portfolio. And so the idea here is to own asset classes that may behave differently during different economic environments, because we don't know when these environments are going to come and how long they're going to last when they get here. And so we look at deflation or recession. It's the same type of scenario. Inflation and low inflationary growth. And we look here, we have bonds have historically outperformed during deflationary environments. So if we look at our patchwork table down here that says during different economic environments, different asset classes have outperformed. Starting on the left-hand side, the time frame 1929 to 1941 was the Great Depression era. Bonds outperformed then because the stock market did so horribly then, and bonds outperformed. Same thing for 2000 to 2014. We had the tech and telecom bubble bursting in the early 2000s, the Great Financial Crisis back in 08, 09, Greece crisis back in 2011, and then more recently we've had volatility, but that's not encompassed in here. But bonds outperformed during that time too. So bonds did well during a deflation-like or during a recessionary environment. Commodities, 1966 to 1981. That's the biggest bout of inflation we've had in the United States history. And we carved out 73 to 1981 right next to that in the middle, where you see the purple box that says commodities. And we did that because 1973 was the year that the commodities index was incepted. And commodities, as you can see, was the only asset class that led the way during that time period, inflationary time period. And then we bookended the inflationary time periods with low inflationary growth. That's the bull market. That's the time when stocks do well. So 42 to 65 was a 24-year time period. And 1982 to 1999, the one we talked about at the very first of the presentation, the heyday, that was the tech and telecom era, and stocks did extremely well then. And so what we're looking at here is really looking at the fact that, yes, we need stocks in our portfolio. We need a growth engine for our portfolio. But we need to be aware of, acknowledge, and account for two things that can derail that growth, that low inflationary growth environment. That's inflation, which we haven't seen at any kind of number for a long time, but it could certainly happen in the future, or a recession. And there certainly talks about a recession right now with low oil prices. Although the odds of that being low, it doesn't matter, because a lot of people thought the recession that happened in starting in 07 and going to 08 and early 09 was odds were low then, and it was horrible for the stock market. So the point of this is really, hey, why don't we strategically invest in different asset classes that behave differently in different economic environments, and that way we have something always working for us. And we can take volatile asset classes like commodities, say, or real estate, and stocks, and things that are less volatile like bonds but still have some volatility, and invest in those things. And then that way we're always having something working for us, fighting fire with fire. And ultimately what we're trying to do here is really use our system of checks and balances, because what we want to have is have that system of checks and balances in our portfolio. And really that's really what this is all about. And so under this framework, the concept of investing is made a lot more simple. Okay? So your balanced exposure to these asset classes that increase your ability to reach your financial goals in a variety of economic, market, or even political environments, versus being dependent solely on an equity bull market. So some things that we learn, build an allocation, meaning how you build your portfolio that provides true diversification. That's a low correlated asset classes, things that behave differently, or investments that behave differently in different time periods and in different environments. So separation of powers in your portfolio. Stay prepared, number two, stay prepared for changing economic environments with strategic allocation. So in other words, if early this year, if we could have timed the stock market being down and being only in government bonds, for instance, because the U.S. Treasury did really well when the stock market was going down negative 12% at this market low on February the 11th, and bonds were positive, stocks were down like 12%. But then all of a sudden the market whipsawed around, and we saw, 10-15% rally off the bottom with the stock market, and bonds that had gained ground earlier lost that ground. So that market timing that we just talked about a while ago is really hard to time. The markets are really volatile like that. And then we want to look at maybe possibly looking at overweighting and underweighting based on market environments. So if we're looking at a good environment, the stocks are doing well like they have in the last 6 or 7 years up until recently, yeah, you want to be overweight stocks in. But that doesn't mean be completely out of bonds, for instance. Because when you have these time periods like what happened in January or August of last year, when we had some China fears, when the stock market had another correction last August, and oil went down below around $30 a barrel again, you have something there to protect you from those stock market losses. So again, the point here is be diversified so then you can meet your financial goals at any point in the future. And that ends my prepared remarks. I want to turn over to Tori to see if you folks had any questions. I'm glad to answer any questions you may have, and certainly thank you for your time.
Thank you so much, Tracy. We really appreciate you sharing your time and knowledge with everyone here today. And as Tracy mentioned, we will now start addressing some of the questions that have been filtering in throughout the presentation. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team, and that information is up on the screen for you. As Tracy mentioned, I did just want to point out that you do have access to financial calculators, and those financial calculators can help you discover what your rate of return would be, how your contribution to your retirement plan would impact your savings over time based upon the amount that you're contributing. So you can always visit the ACECRT website, and the majority of those resources can be located there to help you through your retirement planning. So it doesn't appear that we have any questions at this time, but again, please remember if something comes up later, don't hesitate to call us or email us. We have licensed representatives available to help you. But this will conclude our webinar session today. Thank you again, Tracy, and thank you attendees for your participation. Hope everyone has a great day, and we look forward to our next webinar series with you. Take care.
Thanks so much, everybody. Bye-bye.